And we are live. This is Value After Hours. I'm Tobias Carlisle, joined as always by my co-host Jake Taylor. Our special guest today is Steve Ho. He's a quantitative researcher at Bloomberg Indices. He's the senior equity researcher. He's got a PhD. What's your PhD in, Steve?
Macroeconomics and financial markets.
What did you do your thesis
Dissertation.
on?
I studied this topic, which at the time was a little bit obscure. I was trying to study what would happen if the Fed was to unwind its balance sheet, and what would happen to the essentially bond yields if Treasury supply was to, ramp up and go crazy, right? And
Would the Fed ever unwind its balance sheet?
Yeah, what's the answer? Just smoke
unfortunately,
comes out of all the computers.
unfortunately for my job market, the Fed didn't end up actually going through with it. It was 2018, and you remember the Fed was thinking about raising interest rates and unwinding its balance sheet, and then it got under pressure. Trump was saying, you're being an idiot for raising interest rates, and then one thing led to another. The Fed essentially not only went back on not unwinding its balance sheet, but also stopped rate hikes and started cutting rates. And then the next thing you know, we had a pandemic and interest went to zero again. And the unwinding thing was entirely forgotten. And I never got a job an academic job out of my PhD thesis. But I think the thesis, the title of the paper, which is when is supply effect large in the government bond market, it ironically became quite topical today.
Yeah. Did you have the taper tantrum built into your model?
Well, I mean, that was the motivation, right? But essentially, the intuition of what I found is actually quite trivial when you think about it. It's almost intuitive, right? Basically, I'm arguing that, the treasury yield gets impacted by supply because of essentially, bond investors charge a price of risk for absorbing the supply, right? And the way the price sensitive investors assess the price of risk by looking at the bonds correlation with the rest of their portfolio. In particular, a simple way to proxy it by looking at stock bond correlation, right? If stocks and bonds are very highly correlated, you can imagine absorbing a bunch of bonds is going to increase the overall volatility of my portfolio. That probably means I want to demand a bigger concession, right? A bigger pound of flash for, getting all this supply of bonds onto my balance sheet. But if bonds and stocks are very negatively correlated, as what's been the case from 2000 onward, you had this sort of very persistently negative correlation. Bonds are hedging asset, then you wouldn't see much of an effect. And that's what we saw for about 20 years until basically recently.
Is that anomalous that they're uncorrelated like that? Or
sorry?
Is that anomalous that they're uncorrelated like that? They have been correlated at different times. And I don't know what the trigger is to make them.
So if you just plot something simple like a trailing, so like you can do it different ways, trading 3-year, 5-year, or even 6 months. But generally, you see the pattern is more or less that stock and bonds used to be very positively correlated, right? From the 60s through like late 90s all the way to 2000 almost, right? And then suddenly you see this massive drop, right? And then stock bond correlation started being, return correlation being very positive, and it has stayed positive. Yes, try to creep up and then GFC, right? And then when even more negative. And the broad intuition is essentially how salient is inflation, right? Because you think about asset pricing assets more or less, we're discounting a bunch of future cash flows back to the present day, right? Inflation enters through the discount rate, right? The denominator, right? And it affects bonds and stocks at the same time, right? Bonds have a bunch of nominal fixed coupons and stocks have a bunch of cash flows, right? So when inflation is salient and when you get inflation shock, right? Stock and bonds are going to both move up and down at the same time, right? Now, when inflation is mostly muted, right? And it doesn't really kick in, and you are in a regime as we were in the 2000s, especially after GFC, where it's mostly about the aggregate economy, cash flow news, real cash flow news. That's going to impact stock cash flows, but it's not going to impact nominal bonds, right? So you get this opposite movement. So first order, I think the intuition is basically, is inflation a big deal or not, right? And inflation was a big deal until 2000. China entered WTO. Suddenly you get this massive goods deflation, right? And persistent deflation because of GFC. And then, you have suddenly now we're in a regime where inflation is a big deal again.
And so when sorry.
Well, there was this concept in I think it was the 1980s in the US called bond vigilantes. What is that now? And I feel like you haven't heard that in a long time. Was that just people who demanded a more interest on to give their money to the government and they're therefore vigilantes?
That's exactly right, right? I think Apollo, I tweeted this morning, and you have seen this chart of who is buying the government bonds, right? You can broadly divide them up into different categories. The biggest group is foreigners, which mostly are foreign central banks, right? They are mostly price insensitive, right? They are sort of price takers, right? They will buy at whatever quantity that they've allocated, and they don't really sort of bulk at the price of the yield, right? And then you've got sort of your mutual funds and pension funds. They are relatively price insensitive, right? Because they also invest by mandate and allocation decided every half a year, once a year, like as allocation. And then you've got households, which are private investors, and interestingly, hedge funds are also categorized as households. These are shrewder investors, right? And they are doing the calculus, right? They are like figuring out the correlations and price of risk and how much should I demand to absorb the supply. And those, I think in those days, were the bond vigilantes. I think I wasn't around, but I'm imagining basically it refers to the identity of the bond buyer and their demand elasticity or price sensitivity, right? And the bigger the role they play in the overall picture composition of investors, the more you're going to hear this story of bond vigilantes.
You're at Bloomberg Indices. What do you do at Bloomberg Indices? And what is Bloomberg Indices as opposed to the Bloomberg TV or the monitors or whatever?
Yeah, so yeah, thank you for asking. Give me an excuse to justify to our folks, at Bloomberg why I come on. So Bloomberg Indices. So we basically started this business. The Bloomberg Indices essentially, came from the acquisition of the Lehman Indices, which became the Barclays Indices, the bond indices, the AG, right? That's the bond index, and then we also have the Bloomberg Commodities Index that came from initially a collaboration with UBS and now has become whole-owned. And then I came on to the scene in 2020. At that point, we were thinking about completing our offering by building out the equities indices, right? So we have all of the benchmarks, passive, market cap weighted benchmarks, but we also we've built out, sort of style indices. So when I came on, my first job was to actually build out, a family of vanilla style factor indices, long only, your typical value, momentum, quality, and so on. So that's what Bloomberg Indices is, and you can go on to bloombergindices.com and you can find all of our products and our various research insights, and from the basic stuff we've actually built up more things leveraging Bloomberg data as well.
How does your value index deviate from other value indexes?
I think so. There are two types, right? There is the benchmark type, and then there is the strategy product that becomes licensed as like some sort of investment product. For a benchmark, typically when people just want to track and evaluate their value investment strategy, that construction is not very unusual at all. We try to be as generic and as sort of plain vanilla and explainable as possible. So using the most commonly used descriptions, price to book, so market the book to market, or price to earnings, price to sales, price to cash flow, and you can find like how we weight them and so on. So it's probably equal weighted, with some sort of typical treatment of minimization and combination of different descriptors. So nothing unusual there, and then. if we want to come up with a value index that is, to be tracked by an ETF, let's say, to invest, in a long only, then we'll probably do it in consultation with the client and our own sort of thought process of trying to do it a little bit more thoughtfully with a little bit more of our own ingredients of what we find to be sort of, most applicable, especially in sort of the modern, context, right?
So the index that you have, or you've created an index, the purchasing power index. Can we go through that?
Yeah.
What that involves and how that's performed?
Yeah. So I created a pricing power index. This was like a year and change ago. I recently did a reading of the index white paper with Idea Farm. And the ticker is BPPUS index on the terminal. Essentially, this was 2021, I think, 2022. We were thinking about how to actually sort of, everyone was talking about the concept of pricing power, right? Companies with strong pricing power will do well in the inflationary regime. So, but then there's not like a very clear, explicit way people are thinking about pricing power. How do you define it, right? You can define it by go out and collect a whole bunch of data on all the public companies out there in terms of their market, power, market share, and so on and so forth. That's very onerous, and you probably can't really get a lot of data. So what is actually a reasonable, sufficient statistic? People will think about, profitable companies may be ones that have pricing power, but actually, if you look into it, it turns out companies that have very high profit margins are not necessarily the ones with pricing power, because the margins can be eroded, right? Now, what is interesting is that you can actually make a simple twist, and instead of looking at the level of margin, you look at the stability of margin. In particular, if you look at the stability of gross margin. Now, why gross margin? Gross margin is basically one line item away from revenue, the top line, right? And you just subtract more or less the variable cost, right? That includes your raw materials. That also includes your hourly wages, or if you are Chipotle, right? And that basically captures all of the ways in which you can pass through the variable costs, right? And the idea is that if a trailing 5-year gross margin of a company is not varying very, very much at all, it's probably a very good indicator that this company has got very strong pricing power. So that's sort of the individual motivation. And we built an index using this concept. We'll go into the detail of how we construct the index in the white paper, but that's sort of the idea, and he has actually done quite well, and we have also learned some interesting things along the way.
What have you learned?
So it turns out people sometimes, like, you go onto the internet, like you go onto Yahoo Finance, you search pricing power. There's this pricing power ETF, right? And it's got things like, Nvidia, Tesla, Apple, and all your famous companies in it. And I won't comment on how it's done, but all I want to say is that what we found in our research is, turns out the companies with the strongest pricing power are not necessarily the ones that are glamorous that you hear a lot about, right? Apple, for example, is a very famous company. People casually think it's got very strong pricing power, but if you look at the price tag of the flagship iPhone, it's actually not changed very much for a few years now. Now, you can wonder why that is, but it probably has something to do with between competitor and regulator, right? What we find in our portfolios is that you find companies like a good example I like to refer to is Cadence Design Systems. Have you heard of the company?
No, I haven't.
Cadence Design Systems, what do? They design software for designing microchips, right? There are about a handful of those companies. Ansys is another one. It's being acquired by Synopsys, right? There are like 4 of them, and one of them is acquiring another one. The companies with pricing power are ones that are suppliers in niche industries that you don't ever think about, right? They are basically B2B suppliers. And they manage to have pricing power and retain pricing power because you don't think about them. So competitors are not being drawn to the industry very easily, and regulators are not catching them, catching their attention with regulators very often either. So you've got something like a cadence design system that's designing software for manufacturing or designing microchips. Microchips is all the rage now, and that's a highly cyclical sector, right? But you can never imagine a microchips manufacturer to say, oh, business is terrible, I'm going to cancel my software for designing my microchips, right? You're still going to subscribe, right? Same thing with Adobe, right? So you're talking about sort of that type of company, and they tend to show up a lot in our index.
Just before we move on, let me just give a quick shout out to all of the folks who dial in. Danny Beltran, first in the house. Senator Domingo, Dominican Republic. Navarre Beach, Florida. Bendigo, Victoria. Early stuff for you, good for you. Dubai. How are you? Mac in Valparaiso. Petah Tikva, Israel. Bangalore, India. Mendocino, California. Toronto. Savonlinna, Finland. Nashville, Tennessee. Saratoga Springs, New York. Saskatchewan. Golden Grove, Guyana. That's a new one. Gothenburg, Sweden.
Wow.
Omaha, Nebraska. What's up? Good to see Warren dialing in again. Chapel Hill. Escondido Mine, Chile. Bali, Namal Island, Hong Kong, Tallahassee. What's up? Thanks for dialing in. Let's talk a little bit about your analyst rating improver paper.
Yeah.
What is it? What can we learn?
So, yeah, thank you. That's another paper that I put out recently, actually, just a few weeks ago. This is a concept we came up with by looking at analyst ratings, right? So everyone has heard, like, sort of beyond stock price, the first thing people often look at when they hear a new stock, is to go look at how well rated it is by Wall Street analysts, right? Now, ANR is the function on the terminal. If you have terminal and you type in the ticker, you type ANR, it will tell you all the different Wall Street sales analysts, their rating of the stock, whether it's a strong buy, hold, sell, strong sell, right? And it also gives you price targets, gives you sort of detailed research colors. Now, how do you leverage something like this in forming an investable strategy in a systematic way, right? One obvious thing you can do is just to buy up all the ones that analysts love, right? You get all the sort of top strong buys, right? And you get your Nvidia, you get your sort of Apple, Tesla. Well, maybe not Tesla, because Tesla is famously hated by analysts because
And then you short that basket, right? That's got to be the.
So what we found interesting is that while if you go and just form a portfolio of the top 50, sort of most beloved, stock by analysts, and like say equal weight or sort of market weight or whatever, and you compare it to the broader index, you've done all right, over the last 20 years, right? You've not underperformed, but you've also not really consistently outperformed. You just performed about as well as the broad market. Now, we were thinking, what if you did something a little bit different, right? Because one thing is that we know is that analysts, often they're not wrong, right? But they can be late. They can jump on the bandwagon. By the time all the analysts come to love a stock, when the consensus rating is like a strong, sort of buy, sort of a lot of the upside has already been realized and the stock has already had a good run, right? Now, one thing you can potentially do is to say, what if I toss out all the ones the analysts tell me to buy, right? And I look at the stocks whose consensus rating has improved the most, right, in most recent period. So I will construct a metric that is very similar to how you will construct a price momentum metric, where I look at the average improvement in a consensus rating of a stock from the last 6 months and the last 12 months, right? Just to average out those two. That's how you will construct a price momentum signal, right? 12 minus 2 and 6 minus 2, right? And you build that portfolio. And you find what's interesting is that that portfolio on an equator basis, let's say simple construction, has actually vastly outperformed, right, the broader market, over the last 20 years. And this index is also on the terminal. The ticker is BANRT. So BANR is a Bloomberg analyst rating, right? And then T is total return index. So and I can go into the intuition of why that works, but that's the index. Yeah.
I would like you to do that. Just before you do it, just to clarify, you're looking at it's the momentum of the ratings, or it's price momentum?
It's the first derivative of the analyst ratings.
Correct. So if let's say a stock today's rating is 3.8 out of 5, right? Because we normalize everything from 1 to 5, 1 being strong sell and 5 being strong buy, right? If a stock today has 3.8 and used to have a 2.9, that difference is 0.9, right? And I'll compute that metric for every stock, right? And I'll pick the ones that have improved the most. Except I will toss out all the ones that today has a buy rating on it.
And that's a 5 rating.
Well, that would be a 4 and above.
A 4 and above.
4
Okay.
would be a buy and 5 would be a strong buy. So between 4 and 5 is a range of buys of various types, right?
And then, yeah, you keep on going. You were gonna say something before I interrupted you before.
Yeah, so it's very interesting. Like, you know, you would like, one, it's not obvious something like this will work, and two, if it worked, you kind of almost expect this thing is just gonna be exclusively price momentum, right? It turns out it works, but it's not price momentum. Yeah, in fact, it has a very strong value tilt, right? We end up picking up on a bunch of turnaround companies that have fallen on hard times, that whose fortunes are turning, but have not quite turned so much that analysts are, you know, sort of reaching consensus just yet, right? So you have a lot of, you know, in terms of factor exposure, you have value exposure, you have, you know, ideal vol, because different companies can have, you know, hard time for different reasons. Like most on the white paper, I read about a few examples. I mentioned, you know, Hershey's because of the price of cocoa. You know, you got hit by that, right? Netflix because of password sharing, and most recently, this company. What's the company that Larry Ellison owns? It's called
Oracle.
Oracle, yes. Oracle has had a turnaround. Oracle was falling on hard times as being sort of hated, and suddenly AI kicks in, all the AI services just gone vertical, right? And then we buy it and we dump it because it became too beloved and you got a rating more than 4. But that's sort of the intuition, you know.
So it's improvers rather than
Winners.
Yeah, so,
Correct.
So whatever so it could be a neutral, but because it's improving from sell, then it's preferred. Yeah,
that's
so
right. That's right. I'm sort of agnostic about from whence it improves, right? It could be middling, it could be But although, like, with so much great rating inflation, I mentioned this pretty interesting in the paper that there's so much rating average inflation over the last 20 years. All the stocks are becoming more beloved. I mean, obviously, underlying fundamentals of US stocks have also become better, that you see this consensus rating median going up and up. And what I like about this metric of the momentum improver one is that it's more or less sort of centered around 0, right? It doesn't go up with the average level. So at any given moment, there are some companies that are getting better, some companies that are getting worse. And what's also interesting about this signal, by the way, is that it works not just in the US, it works in Europe, it works in APAC, right? It works in EM, right? And if you look at US and Europe, for example, it's a very interesting contrast. American analysts are so much more optimistic than European counterparts, right? Sector by sector, time by time period, they are consistently about 0.25 higher than the European one. Like, give you a good example.
USA.
Eli Lilly, right? Zepon today, they came up with a new drug. Eli Lilly is a beloved company, right? In America, the rating is about 4.67 or something. It's a strong buy, right? Now, do you know that European competitor, have you heard of them? It's called Novo Nordisk.
Sure.
Right. Novo Nordisk invented Ozempic. Now, take a guess what Novo Nordisk's consensus rating is on Bloomberg Terminal.
0.25 lower.
Is 3.97. It's not even a buy. That tells you, like, it's very hilarious. Like, I have this paper, you can go on our website, bloombergindices.com, to find the ANR paper. Maybe we can put it in the link below later too. That you sort of compare the ratings, right, sector by sector. Like, you know, the American analysts just, you know, give higher ratings to their stocks than European analysts. Anyway, it's just a little factoid that I thought it's interesting to bring up. You know,
I got a question from the crowd here. Does it work in reverse? Does it work for finding shorts?
Yeah, I mean, in theory, sure. I mean, we created a, you know, index as an ETF, right? So yes, launched as an ETF with the Invesco we didn't, we did a quantile analysis and you see the monotonicity and so on. We didn't investigate too heavily into how you get implemented realistically as a short strategy, and but it certainly is a promising direction.
Weren't like Lehman and Enron both still like strong buys like a week before they filed for bankruptcy? It's like,
Yeah. There's definitely a lot of I think persistence, right? Because that goes into the sort of analyst, psychology and culture. Like one interesting thing is if you go into the paper, go into the appendix, the two geographical regions in which that has the highest consensus rating is North America and Asia, right? In Korea, the analyst ratings are off the charts, right? And what I was told is not because the companies analysts there are so optimistic, as much as I think there is a expectation that if you cover my company, you have to give me good ratings. Otherwise, I won't let you cover my company, right? So I'm sure there's
it's an access issue.
Exactly. So I think some of that is probably also present. You see that in Taiwan as well, by the way.
I want to do some questions about the economy and the macro economy in general, but before we do that, JT, do you want to do your vegetables? Do it a little bit early today.
Sure.
Steve, we have these Jake brings some interesting learnings for everybody, and then he tries to from an unrelated area.
Okay, am I getting a quiz?
No, well, maybe, but then he tries to make it related to investing. So that's the best part of the whole thing.
Yeah, that's where usually where the wheels fall off the wagon. So this week, and this is just happens to be a coincidence that we have someone of Asian descent on the show, but we're going to delve into the world of Bruce Lee today, and so I just happened to be flipping on the TV and Enter the Dragon was on. And of course, it's like really hard to keep going once that's on. You got to just stop and watch it. And I just remembered how much I love Bruce Lee. And then, not only was he, just a badass in these martial arts scenes, but there's like this inner strength and coolness that to me, like just exudes from him that I've always been attracted to. So, of course, everybody knows he died super tragically young at just 32 years old. But he left us a treasure trove of wisdom that's not just about fighting, but thriving, and maybe we can even draw some investment parallels. And so we're going to center off of 4 quotes from Bruce Lee. So number 1, let's kick it off. Maybe his most famous piece of advice, which is "Be water, my friend." Now, this isn't just about, fluid movements in martial arts, although he did emphasize what he called the style of no style in his fighting. Like he didn't want to be that formalized and traditional in his approach. He wanted to be like water. And I think there's something powerful there is investment strategy as well. So, picture water ever adapting, flowing, taking the shape of its container, finding a way around obstacles. And investing, I think this kind of translates to embracing opportunity, however it presents itself, and then navigating these challenges without forcing things. So sometimes, nets are available, like in Korea in the early 2000s. Sometimes it means getting a super high quality business franchise for kind of an ordinary price. Sometimes it's merger arb, junk bonds, spinoffs. The point is to have lots of different strategies that you can flow toward depending on what the environment is calling for. Avoid labels, like have the style of no style, accept this fundamental precept of getting a lot for your money, perhaps, and making, good risk reward decisions. And just like water, like you don't have to force it, and kind of take the shape of the container that's offered by the marketplace. Related to this concept is Wu Wei, which we've covered in season 3, episode 40, if you want to kind of double click on that concept. Toby, what's the good working definition of Wu Wei that you have?
Yeah, flow state, being in just the right thing at the right time, minimal effort, efficiency. I think.
Is this a Chinese phrase?
Well,
yes.
Wu Wei is.
Yeah.
Right. Sorry.
It's Taoist, isn't it?
Okay. Okay. Wu Wei. All right. Yeah. Okay. Yeah.
What does that mean to you, Steve?
I mean, it is a famous phrase from Taoism. It means, doing by not doing, I guess.
Yeah.
Yeah.
Yeah, that's right. Effortless
achievement.
Yeah. All right. Quote number 2. I fear not the man who has practiced 10,000 kicks once, but I fear the man who has practiced one kick 10,000 times. So this is really about mastery, focus, repetition, closing feedback loops, super deep concentration, deliberate practice. Really, you got to put in those reps, right, in order to be good at this. And it's this relentless pursuit of improvement that leads eventually to exceptional results. And it's very nonlinear. Shane Parrish has this great quote that's 90% of success can be boiled down to consistently doing the obvious thing for an uncommonly long period of time without convincing yourself that you're smarter than you are. All right. Related quote number 3. The successful warrior is the average man with laser-like focus. So in today's world, filled with digital distractions, having a laser-like focus on your most important goals is, I think it's damn near a superpower these days. In researching these veggies today, I stumbled across some of Lee's personal journals, and it became clear to me that based on the wording that he used, and there's these little clues, these mantras that he would repeat to himself that in his journals, I'm pretty positive that Bruce Lee at one point read Think and Grow Rich by Napoleon Hill. And I think it had a major impact on him. So I personally think it's a terrific book, and I'd encourage anyone to read it. And I'll give a little unsolicited parenting hack that I've personally implemented. I thought would be fun to share. So I bought each of my boys a leather-bound copy of Hill's classic, and it looks very serious. It looks like a Bible. It has black leather. It's gold embossed writing on it, very, very Bible-like. And I think there's something to the weight of a message that is derived from the medium that carries it, right? This feels very serious. So when each of my sons, when they turned 12, I gave them their copy of Think and Grow Rich. And before that, I went down to the bank and I got a big stack of $2 bills. And I put one bill at the end of each chapter in the book. And I told them that cash would then be unlocked as they read through the book and, got to the end of that chapter. The only catch was that the money had to be spent in pursuit of their dreams. So that was kind of my little parenting thing. You guys can steal that if you want.
That's a good one.
Excellent.
Yeah. And then last quote number 4, there are no limits. There are plateaus, but you must not stay there. You must go beyond them. If it kills you, it kills you. Now that part I'm not sure I agree with, but this is really about, pushing past your boundaries, embracing that mindset of continuous growth. In any pursuit, you're going to run into plateaus, and it can be really disheartening and frustrating when you feel stagnant. And I think investing is no different. I mean, it can feel like Groundhog Day. Toby, tell me if this rings true for you. Mag 7 up, Russell 2000 value down, value spread widened again, yield curve still inverted. I'm going to stop now before you start crying. But
I think that's excellent. That's an excellent segue because we've got Steve here, and that's exactly where I was going to go next. What do you think, Steve? Where are we? Where are we with all of that? The economy, the stock market. Inflation. We're gonna go through all of that with you now.
Well, let me just finish these off.
I'm sorry.
Because if I lose my train of thought, I will never get it back. All right. So after all that, I'm just teasing you, Toby. I think this too shall pass. And even when you feel bored by the market, you can still keep working on your skills. I think Peter Cundall said something like, there's always something to do. That was the title of a book of his. You can learn about new businesses. You can learn about new business models. You can discover new mental models. You can add new analogies to your toolkit, which I'm kind of like to work on. You can read history. You can look for interesting data correlations like Steve does. You can read trade magazines, get your physical and mental health dialed in so that you're kind of ready for battle when it does shift into the next phase. Work on your metagame of, sharpening all of your processes, keep score, track your KPIs. There's lots of things you can always be working on. And if you think about complex adaptive systems in general, like the stock market, there is no standing still. The market's always adapting. It's always neutralizing edges. And the bar's always being raised for what's expected of you. And so if you aren't serious about that active improvement and you're not putting in the dedicated work, you're naturally falling behind. There is no treading water, really. You're either advancing or falling behind. So I think, Bruce Lee's wisdom, I think, offers us incredible guidance, not just for the martial arts, but for achieving excellence in any field, including investing. And so remember to flow like water, master your craft, stay focused, and keep pushing your limits.
That was a good one.
All right, over to you, Steve.
That's a hard act to follow.
let's start with where are we in the economy? How do you see it? Are we in a recession? Is there a recession approaching? Have we had a growth scare? Is this what always happens in the lead up to an election?
We're
What's your
climbing
sense?
the wall of worry.
I think we are living through, for something cliche, the most extraordinary macroeconomic episode in modern history. I don't think we are in a recession. We're definitely not in the recession right now, and there are very, very many indicators we can point to say that. But I also don't think that we're not at danger of getting into some kind of a sharp economic slowdown that end up in a recession if we're not sort of careful or lucky, right?
Steve, can I ask, would we be in a recession now if we weren't running trillion-dollar deficits?
I mean, that is a very difficult question to answer. With macroeconomics, there's so many confounding variables. I know what you're getting at, right? There's just no question that broad strokes, I think there is something to the effect of the Fed having acted too late, the federal government having issued too much money, fiscal stimulus, between the two presidents, and then the Fed having to then come back and perhaps overcorrect, that the two things kind of offset each other, right? We crash landed into a marshmallow. That's how I like to think about it. Now we're still, because we've fell so hard, right? That we're crash landing into a big piece of marshmallow so fast, so forcefully. What the end outcome depends a little bit on the thickness of the marshmallow and the speed and momentum with which we're going to fall and crash, right? And we are trying to arrest the momentum a little bit, with the Fed now starting to talk about, starting to, cutting rates, right? And so on. So yeah, that's where I think we are. So I think we are going through some episodes of growth scares. We already saw one last month. We saw the jobs numbers, and it came in very low, right? And then it almost was like what economists call like a pixel problem, where it's not news, right? If you look at all the indicators, the ones that matter, the ones that I watch, right, which basically is the labor market, which is the only one that really matters, right? Forget about everything else. Whether it's job openings, whether it's a hire rate, like how many people, being hired, the quit rates, how often people are quitting their jobs. Unemployment rate has been ticking up, right, steadily from a very low level, albeit, right? There are just very many. Wage growth has been steadily slowing. In other words, no matter where you look, right, the economy has been steadily slowing. It's just the last month, I think everyone got like a sudden wake-up call. Wait a second, hold on, right? We may actually be entering a recession. And it's funny enough, it's because of this indicator that has become famous by my fellow U Michigan, alumnus, Claudia Sun, right? She was a few years ahead of me. She invented, when she was at the Federal Reserve, this rule called the Sun rule, right? Which says, if you look at the rolling 3 months, U3 unemployment rate increase, and if it breaches 0.5%, historically, it has always sort of been followed by a further increase in unemployment rate and a recession. And everyone suddenly just saw that indicator being triggered and say, oh, wait, we're going to be in a recession, market sell-off, which coincided with this Japanese shortfall, carry trade blow up, and everything happened at once. But then we obviously have to come on the other side of it, like it snapped right back, right?
That was a scary 10 minutes there.
but yeah, I mean, that was basically one episode of a growth scare. And I think we may still have more, but we also, I think, gonna have conflicting indicators, right? Since the job report, we have had retail, we have a consent, sort of continuous claims, essentially people who are on unemployment insurance. We are seeing signals that maybe the economy is actually stronger than certain numbers indicate, right? And I think we just have got a lot of confluence of different factors, because a lot of the aggregate statistics are a little bit screwed up, right, during the pandemic. all these numbers that we see, they all come from surveys of either households or companies, right? If it's unemployment comes from survey of households and payroll survey comes from survey of companies, all of these surveys are being responded to with a much lower percentage. It turns out people are suddenly realizing, wait a second, there's this thing called pandemic will die any moment. I'm not going to just fill out some long questionnaire for nothing, right? And yet on top of that, right, the most prominent political issue across all countries today is illegal immigration, right? It turns out if you have illegal immigrants that are here in this country and working to support themselves in one form or another, they probably won't be reached by a household's mail survey, right? Because you don't know where they live. And even with companies which may report them as part of payroll, may not be fully reported because companies may not always want to report how many people they are hiring that may or may not be fully compliant, right? So you just have a lot of noise in these, aggregate statistics. That's why, we are sort of, we're almost experiencing a mini version of what I call the March 2020, where we are sort of whiplashing a little bit based on noisy little clumps of data, because on the other side, the uncertainty is enormous, right?
The Fed seems to have decided that it's time to cut, or that's what came out of Jackson Hole from Powell last week. They say September. What are the things that they're looking at to decide that now is the time to cut? And like, how do they consider that? We've got the stock market's essentially at all-time highs. Housing market seems to be expensive by any number of different measures. Unemployment seems to be rising, but as you point out, it's still historically pretty low. How do you come to that? How do they arrive at the conclusion that now is the time to start cutting?
Give me one second.
That's a trap.
Yeah, give me 1 second. I have a bit of noise here because one thing is you might give me a minute. Okay.
Well, can we?
Yeah,
I asked myself the question also, like in 20 years, will those 25 basis points mean anything?
Yeah, it's obviously not about this 25 bips, right? Why is the Fed looking to cut even though asset prices are historic high? The Fed basically looks through asset prices, right? Like, why do we, for example, why do you bring up asset prices? Because casually you have this intuition that asset prices must translate into purchasing power because, people feel richer, right? Wealth effect and so on. But it turns out historically, if you look in the data, there's not much translation from, asset prices into inflation, right? And I think mostly it's because assets are overwhelmingly owned by wealthy people, right? Whose consumption needs are fully met. And additional wealth does not actually translate into additional consumption very much at all, right? So you very much have got this K-shaped thing where, this inflation is being accomplished by squeezing the asset-light, income-dependent people who contribute the most to CPI basket consumption, while the wealthiest people who own all of the assets are seeing their assets go through the roof. So you see a lot of asset inflation, but CPI inflation is actually not responding to it. And the Fed is mandated to care about CPI inflation. So, if they see things that might threaten the other side of their mandate, which is, jobs, they will start cutting. And the other side of the things that will affect jobs are actually flashing red. So you've got this very weird combination. Yeah.
So the sum rule has been triggered. Is that right? So it does seem that. So is that what they're looking at? They're saying, well, it looks like unemployment is coming.
Well, sum rule, it's a historical regularity, right? And even Claudia Sampson herself has said this probably does not mean, the same thing as it used to mean. And for the most part, unemployment has gone up because an expansion of labor force, right? We've got more people looking for jobs as a result of, in part, illegal immigration, and in part because of just more people entering the workforce. In any event, you've got this rise in unemployment rate. Now, what does that mean in terms of actual job market? The Fed does not just look at the sum rule, right? The Fed looks at a broad set of indicators, of which this momentum of unemployment is only just one, right? The sum rule even if you don't respect that it has a sharp threshold at 0.5, that you always have to hold this intuition that once unemployment gets going, right, starts rising, it has a certain momentum that you will keep on rising a bit more. And you don't really want that to happen, because that usually is what recession is, right, fundamentally, right?
Yeah, I think you saw that with like the tech companies, like until someone went first, they didn't feel like it kind of had the political cover or the safety to go lay people off, right?
Yeah, so so far we have not really seen very much layoffs yet. Unemployment rate so far, what's been reassuring is mostly come from the lack of hiring. Because remember, like people move in and out of the workforce for non sort of economic reasons, right? Sometimes people leave a job and then they don't get replaced, right? So that just contributes to a lack of movement and harder to find a job. The same way we see in the housing market, by the way, right? The existing home market has more or less frozen, right? People are not buying, not selling, and the reason people are not selling is because they can't really buy one wherever they go next, right? So you have this sort of two-sided market that are both frozen. In the labor market, it's sort of a similar, right? So you don't want to lose a job now because companies are very cautious about hiring new workers. But they're also not laying people off yet because they just had this whole experience of not being able to find workers, and it's all just a whole hoarding workers. So for as long as profit margins are relatively healthy, they're going to want to hold on to their workers, which you are seeing, right? Profit margins, after-tax margins are after-tax margins are at historic high levels. So that's sort of the weird situation we're in.
The Cam Harvey has this 10-3 inversion that he says the uninversion is the event most close preceding the the declaration of a recession. A little bit like Claudius Psalm, he's sort of disavowed the signal as well. I guess I've got two questions. Why do these researchers disavow their signals? And secondly, what do you think about the 10-3 and the prospects for that sort of preceding recession?
Well, first of all, if you sort of just take a step back and you look at all the episodes, right? All these episodes, they say, oh, all these times he has always predicted recession. We're looking at most 9 episodes, right?
Yeah.
And typically in statistics, we say what? You need at least 30 data points, right? If let's say they're all uncorrelated. Here you have got 9 highly probably correlated samples that are episodic, right? Because in the 70s, they all sort of happen, in the same fashion. There's really not very much robust inference you can draw from the 9 data points to say about the 10, right? So that's point number 1. Point number 2 is that I think we are just in an extraordinary, unusual set of circumstances where we have never crashed so hard into such a big piece of marshmallow before, right? We've never had this much fiscal stimulus support onto what was already a very healthy U.S. economy, with U.S. households having historically high home equity, high net worth, right? Very strong balance sheets on the bank side, and so on and so forth, right? And you have basically robust, labor market wage growth. That the historical channels through which for example, the yield curve, right? Yield curve is supposed to discourage bank lending. And that would basically discourage, then you would make it difficult for you to finance your new economic activities, whether it's buying a piece of furniture, buying a car, or buying a house, or on a firm side sort of capex, right? Now, if you are already awash with liquidity because you had termed out your debt and you have a lot of income and the firms already have access to liquidity through other means, this squeeze is not going to feel as painful, right? You're still feeling it, right, in certain corners of the economy, but broadly, the pain is just so much more blunted that you're going to have a more delayed response. Is how I'm thinking about it.
It
We
does
should all
seem to
take a second to appreciate that. We've had money, call it, for 5,000 years, and we just now figured out exactly how you can just print the right amount, and then you don't ever have to deal with any real problems. What a lucky stroke for us as a species.
Well, it works for some countries better than others. It seems to have done wonders for America so far. And you look at the UK, I think the Prime Minister in the UK just mentioned there's going to be pain to come. And Australia, Tobias's home country, isn't doing so hot either, from what I vaguely have heard. Is that right?
Yeah, I haven't followed that
We
closely,
had
but
we had a man on the street there, a couple months ago.
yeah,
What's
it looked
the
pretty rich when I was down there, honestly.
Yeah.
It looked a little bit overheated, so maybe they could raise some rates down there a little bit.
Mm.
I I was going to say that the increase in rates has probably impacted small and micro and maybe some mid companies definitely more than it's impacted the very big end of town. And I think that there was that there was a funny little round trip that small and micro did in the end of July. It sort of ran up really quickly and then ran back down. And then on Friday, when the the Powell news came out of Jackson Hole, it all sort of levitated up as well. Why do you is there some sort of connection between rates and small cap? Are they more closely tied?
I mean, so that's exactly right. So to the extent that we were just talking about rich households and the poorer households, right? They have this dichotomy where, one is being hurt very much and another side is really benefiting. You've got a similar dynamic mirrored on the corporate side, right? You've got your Magnificent Seven, right? They are generating wads of cash flow. This is sort of, on whatever network externality they have managed to create. So they are not very dependent on external financing, right? They can finance all of their capex using internally generated cash flow and earning interest rate along the way on their cash pile. On the other hand, you've got the smaller companies that are more dependent on credit, right? They are more sort of still cyclical, right? Small value companies. So not only they get sort of almost a double whammy in a recession here, because if we get a recession, the cash flow side of their business gets absolutely whacked, right? And they go down, right? Now, if interest rates don't go down, they get hammered on the financing side because they all have to roll over onto unaffordable interest rates on their sort of credit. So they really benefit from a soft landing thesis working out, which is why we saw this round trip in July where sort of we had this growth scare, right? And suddenly, they look like they may be actually entering recession. But then they also get hammered if we get bad news on inflation front, and maybe rates won't go down very much, So what's really bullish for, I think, the smaller cap value-ish companies is really for this, soft landing thesis to work out, which is actually, I think, reasonably the base case, at least in my opinion.
Tom Lee, who's Fundstrat on Twitter, he's a market commentator. He says that small and micro is going to levitate 40% by the end of the year, which I don't believe it for 1 second, but I'd love it to happen. I have no idea what he's based that on, but is that a interest rates being cut rapidly? Is that the only way that happens?
I don't know. I've not read into Tom's mind. I mean, we have had sort of sporadic chats in DMs. He's clearly been proven extremely prescient over the last couple of years. He is what some people may like to call a perma bull, and he's been very bullish on the large cap, the Magnificent Seven. Then suddenly he's like, oh, by the way, I'm not that bullish on the Magnificent Seven anymore. I think they're just going to go sideways. But in the meantime, I think the rest of the market is going to go up by 40%, which sounds a little bit hyperbolic. I mean, more than a little bit. But he also made hyperbolic predictions about the Bitcoin price. I don't know what to make of his hyperbolic prediction, but I do think that probably is aligned with there not being a recession and interest rates coming down as currently forecasts, and then you get this sort of Goldilocks situation that really will benefit small cap value that has just been suppressed for such a long time, right? So I think something to that effect, directionally, qualitatively, could happen. We've certainly seen days in which like the Russell is like up 3% when the Dow itself is up 80 bips or something, right? But I don't know whether we actually get 40%.
But that's what the models say. So that's what you get to.
You don't look at that trend in unemployment and think, when historically it's been pretty consistent. When it starts taking off, it really goes vertical. That doesn't concern you? That's going to happen?
I think when people say something like that, there's an implicit assumption about the nature of the economy being more or less the same as the past, right? A lot of the sample we were talking about is from the 60s, 70s, 80s, I mean, if I ask you, Tobias, do you think today's U.S. economy is comparable, in nature to economy in those days? I don't know if you actually would so readily say yes. There's a lot that has changed in a very big way, right?
Yeah, for sure. No doubt.
The economy has become a lot more services oriented, right? Manufacturing has become, much less important, portion of the economy. So when we say manufacturing sentiment, PMI is in some dire straits, what does that really mean, right? Meanwhile, you go outside, you walk on the streets, people are like, walking up and down the strand, having a good time, consuming like there's no tomorrow, So it's kind of hard to, I think, square those two. I do think there is something structurally different about today's economy. It's not to say that there cannot be momentum in unemployment that keeps going up. And I personally believe that if the Fed does not start easing, right, you're going to start seeing, an acceleration of weakness in pockets of the economy, right? That being said, I also don't subscribe to the view some teams seem to hold, on Twitter and elsewhere that it's already too late and we're going to, necessarily enter a recession.
Because there's such a long lag between when they act and when it sort of shows up.
Actually, I want to argue the opposite. I want to argue there's actually a very immediate response that if rates come down, you're going to have pockets of the economy that will instantaneously react, right? Whether we are talking about refinancing, people taking out money out of their, equity, right, or home equity, right? People today, I think we're sitting at probably the highest home equity since 1960, right? In the US, it's just been like a one-way recovery since GFC, right? And the last few days, I've been checking my email. I've been inundated with email from Rocket Mortgage and Bank of America saying, "Hey, we urge you to take money out of your house." So there is a lot, I think, of net worth to support, and you've got a secular demand of housing from millennials who have been shut out of the housing market. They're now eager to form a family, buy a home somewhere. And suddenly rates went so high so quickly, and home prices have not come down that they couldn't buy. So if rates come down, even just marginally by a few percentage points, you're gonna see this, sort of spring of activities coming up. Not to mention the unlocking of the existing home market, right? People have not moved. Historically, people will move across countries for jobs that had nothing to do with the value of their homes, right? They'll, buy somewhere and sell somewhere, and that entire market will get unlocked, right? That means that people who are realtors will get hired, people who are in renovation are gonna find business, and so on and so forth, right? So the operating leverage on interest rate actually can be very fast and very high. That I think, if anything, the lag, is very short. Is instantaneous, in fact.
I should ask you, I've got a question from the audience here. It's sort of related. Any thoughts on the banking system health? Equity ratios are double from the pre-GFC for some banks. Do you think that's sufficient to reduce the intensity of a recession?
Well, first of all, I've already said I don't believe we have a recession in the cards, but even if we did, I think it's going to be a pretty mild one, just like a skirting one. I think the banking sector is rock solid. I'm not a banking expert by any means. You want to listen to some Outlaws episode with Steve Eisner, who was in the Big Short movie, and he explained this back in February, very last February, very eloquently. All the major big money center banks are, have what I think Jamie Dimon calls fortress balance sheets. They're just rock solid. The US has, well, many people don't know this. We've got thousands upon thousands of banks, unlike other countries in the Odyssey. We've got 3,000-4,000 banks, like a long tail, tons of banks that you've never heard of, right? Local banks. And the fact that we're going to lose a couple hundred here and there, it really should not alarm anyone, because their weights in market weights are very tiny, right? And their lending sort of can easily be substituted by a competitor that will acquire them, easily. So what we saw with SVB was kind of a unique situation, but generally, I don't foresee the problem to come from the banking system this time.
Well, that might be a good note to leave it on, Steve. Thanks very much for your sharing your thoughts with us today.
Yeah.
Steve Ho from Bloomberg Indices, thank you very much. We have an unusual podcast scheduled this week. Tomorrow we have Guy Spear coming on the show. We're going to be starting a little bit earlier than usual. I think it's about 10:15, but we'll be on tomorrow with Guy. Steve, thank you very much.
Thank you so much for having me.
And Steve, if people wanted to follow along with your work, what's the best way for them to do that?
So they can definitely follow me on Twitter, Steve Ho, and Steve Ho F actually with an F at the end. They can also find my work on BloombergIndices.com. And Tobias, maybe we can put a couple of my papers link in the bio or in the video description. And they can certainly also reach out to me at FHOU9@bloomberg.net.
Awesome.
Great.
Thanks, JT. See you tomorrow. Thanks, everybody. We'll see everybody tomorrow with any luck. Steve.
All right. Look forward to that. I'll be tuning in too.
Awesome. Thanks so much.